A lot of people ask me about NVidia. It's like the most popular stock right now. It's exceeding Tesla, which used to be the most popular stocks. And NVidia has earnings coming up next week. So it's a risky period of time to be holding NVidia. That being said, the stock has corrected about $50, right, over the last couple of months. And it is now it's in a short-term downtrend, but a medium-term and long-term uptrend. And so you want to try to catch this stock and sell covered calls against it to create some income. In this video, I'm going to show you how to create about 6-7% of income in just less than a week. So here we go. Okay, so today is the 19th, which means in 9 days, which is, like 7 trading days, we have a report coming out from NVIDIA. Let's take a look at this chart, and you can see that NVIDIA has been in a short-term downtrend. Long-term uptrend, but a short-term downtrend. So what we want to do is we want to maybe capture an early entry, because this stock may, I'm not saying it will, I'm saying it has the propensity of maybe running up based on all this hype going into earnings. Now, of course, it depends on the market, and the market's green right now. So the probabilities are starting to stack in favor of the stock being more bullish going into earnings. We'd rather have the stock not go down. We don't care if it goes up that much, but we'd rather have it not go down, right? And stay the same or go up is what we're going for here, because we're doing covered calls on this stock. So let's take a look at the chart. Short term, we have this little downtrend. And so you could see this, I've drawn this little line right here. This is an early entry. The real entry here is around 141. If we have to wait till that happens, and that could happen on the day it makes earnings, this stock could easily open at 150 or it could open down below 100. I mean, it's that kind of stock. So I'd rather not give us too much exposure going into numbers. So here's what I would look at doing. There is a little spot on the chart right here that I would say is the one we're going for. It's about 128, right? The stock today is around 125. So if we can get this stock to get to 128, chances are it will break through, hopefully, with all the market tailwinds that we're getting, and go to 140 and then break out from 140. That's what I see here. Now, the risk is this is a later stage base. We've gone up, we've consolidated, we've gone up, we've consolidated, we broke out, and now we're in this third stage base, which is a little bit riskier base. What I'm suggesting here is take a shot at getting in this early. Now, do your research and all that stuff. This is for education and information in the beginning of your research, not the end of it. But take a shot at getting in early. Getting in here at 125 up until 128, something like that. And then hedge your bet by selling calls, covered calls against this stock. Okay? And so if you do that, you can make a good percentage. Let me show you how that works. So if you look at this option chart, and if you don't know about options, then you should watch one of my other videos. But basically, you're agreeing to sell your stock to somebody else at a predetermined price before a predetermined date. Now, I'm going to go out, instead of going out these 3 days, I'm going to go out next week. Now, we have earnings on the 28th. So I don't want to hold this all the way. What I want to do is I want to hold this until the 28th or 27th and get out of this trade. Now, I'll be able to collect most of this juice if the stock stays the same or goes up. If it doesn't, I'm collecting a little bit of hedge and a little bit of cushion. So the stock right now is about 125. You can see that right there, 125.08. So what I'm going to do is I'm going to go one strike out of the money. If I go one strike of money, I'm going to buy the stock for 125, whatever it is here, and I'm going to sell the call. You can see the calculator does the work for you. You see where it says $7.13? That's the maximum upside if I sell the 125s. I'm going to sell the 126s, just a little bit out of the money. So my maximum upside is $7.63. If you look at that, it's 6.1% on this trade. And this is a 9-day, an 8-day trade, something like that, because we're not going to hold it all the way to completion. We're going to trade it and get out of it, and it's about a week-long trade, and we're going to make 6%. It gives you the annualized number if you hold this all the way to term at 222%. But we're not going to hold it all the way to term. We're going to just try to make that number. Let's say we just get half of that, or let's say the stock goes down the other way. Well, if it goes down the other way, we're collecting $6.85 worth of juice, which allows that stock, if we get in here around 125, to go all the way down to 119 before we start to lose money, roughly around there. So the covered call strategy really does a couple of things. Number one, it gives you protection by taking advantage of the gambler, the person that's willing to buy the option from you to sell the stock that you have to them. number one. And number two, it gives you that downside cushion. That's probably the most important part of this. We want to make the $6.80 or whatever it is on this trade, certainly. But at the same time, we also want to protect our downside. Okay, so it's about 3:45. This is a screenshot of NVidia and the options, and they're moving all over the place. The stock is about to report earnings, and I'm not a big fan most of the time of holding a stock into earnings, like I mentioned earlier. So we're going to get out of the position. The stock is up from where we bought it. It's at 126.35. And of course, the options are also up, which works slightly against us. They're at about a $7.15 buyback if you look at the 126s there. So let's look at the math. To close out this trade, we're selling the stock at 126.35. We're buying back those call options at 7.15, and we're collecting 119.20. Now remember, to figure out the profit, we have to subtract our basis. So we make 119.20 on today's trade, but we've got the basis of 118.40. And so we make 80 cents on the trade. Not a huge amount of money, but I'd rather make money on the trade than lose. And NVIDIA could move up or down 20 bucks, after hours or tomorrow's trading. So I'd rather not take that chance. I'll just take a small profit on the trade and move on to my next one. Okay, here we are on Thursday morning. NVIDIA had good numbers. They announced the stock buyback, and the stock was down at 115 after hours trading. I kind of don't even count that. It's just that's all the Aunt Susie's and Uncle Bobby's trading, and those are usually the chickens, right? So they're getting out early, and the market makers know that, and they take advantage. The big money takes advantage of the little money. And so you're seeing this stock on a 1-minute chart now, just opened here after earnings. And again, the earnings were really good, but sometimes these expectations can be blown out of proportion, and then people take their profits and stuff off the table. The whole point here is if you're looking at that stock, you can see it down below 120 this morning, and right now, trading almost at 124, moving all over the place. And what you want to realize is that you don't want to take these chances because, we sold out at 126.35, I think, and we had to buy back our calls. We made a profit, but we might have to sit on this, at 124, even though it's down only a couple bucks, and wait for it to come back, and it may not come back for a while. So we'd rather just take our small profit off the table, even though we could have maybe made a bit bigger one. I'd rather take a little profit than a big loss. So that's the way I look at it, and I'm getting ready to move on to my next trade, and I hope this was instructive for you, but it's really a lesson in why you don't hold into numbers, because NVIDIA could have been up 20 bucks or down 20 bucks today. Fortunately, it's right around, a couple of percent from where it closed yesterday, but still, there's a big risk of taking an overnight position on a stock that's about to report earnings. Okay, here's a quick update. It's 10 minutes to 10, and you can see the stock has lost a huge amount of time premium. The stock's about the same spot where I reported when the market opened at 123.71. But look at those 126s that expire. They're now worth $1.33 to buy them back. Now, yes, we've lost a couple of $3 roughly, or $2.50 from where we sold. But we've gained, look at all the time premium that we have gained in that. So not saying that you should have held the stock or not held the stock. What I'm saying is that after earnings report, there's a huge amount of time premium decay because these options expire tomorrow. So now they went from like $7.15 where we bought them back, and now just a few minutes later, really in trading time, they're only worth $1.33. That's a $6 increase, and that goes right into your pocket, even though the stock has gone down as well. Interesting stuff, right? Hey, it's Mark Yegi here to tell you about our cash flow machine trading program that's designed to teach you how to make safe, reliable income. Now, we shoot for 2 to 4% a month of income and growth in your portfolio. And we have courses to teach you how to do this yourself or inside a mastermind community. And the best part of that is it only takes about 20 minutes a week to implement. So to learn more about this program, go to cashflowmachine.io. That's cashflowmachine.io, and you can learn more.